It has been a brutal few weeks for the stock market. If you looked at your portfolio recently, you probably saw a lot of red. The S&P 500 took a hit, and top tech stocks were under massive pressure. We all saw the terrifying headlines. Geopolitical tensions in the Middle East, volatile oil prices, and fears that inflation was coming right back. Most retail investors did exactly what you would expect. They panicked, hit the sell button, and moved everything to cash, waiting for things to look safe again. But right now, something interesting is happening. The market is starting to stabilize, and smart money is quietly buying again. I understand the fear of the last few weeks, but here's what separates the investors who build wealth from the investors who stay stuck. They do not wait for the news to be perfect. They buy high quality assets just as the recovery begins, before the rest of the crowd catches on. And that is exactly what we are going to talk about today. In this video, I'll show you the simplest way to take advantage of this market recovery using one specific ETF, especially with an important change happening in April 2026. Welcome back to Rebuild Finance. This channel is about documenting a real journey to build a $1 million portfolio. Step by step, decision by decision. My goal is simple. Find elite assets, buy them at fair prices, and hold them for the long run. If you enjoy this kind of transparent analysis, make sure to subscribe. Now, if you are looking at this market and thinking that individual stocks feel way too risky right now, I completely get it. When headlines scream about war and inflation, betting your money on single companies may be difficult. An earnings miss or a bad news cycle can wipe out 10% of a stock's value overnight. It takes a massive amount of conviction to hold a single stock when the whole world is panicking. That is where exchange-traded funds, or ETFs, solve the problem perfectly. ETFs give you instant professional diversification. Instead of owning one stock that could face massive specific risk, you own hundreds of the best companies in a sector. You get lower specific risk and usually dirt cheap fees. Even if one or two companies in the fund perform poorly, the overall performance of the other companies balances it out, protecting your capital from complete disaster. During periods of maximum uncertainty like right now, ETFs are genuinely the smartest place to park your capital, and the timing for this could not be better. Vanguard recently made headlines with a massive announcement. They are executing stock splits for 5 of their major ETFs, and it is all happening now in April 2026. Let me break down exactly what they are doing. The Vanguard Growth ETF is getting a 6-for-1 split. The Vanguard Mega Cap Growth ETF is getting a 5-for-1 split. The Vanguard S&P 500 Growth ETF is getting a 6-for-1 split. The Vanguard Mid Cap ETF is getting a 4-for-1 split. And finally, the Vanguard Information Technology ETF is getting a massive 8-for-1 split. So what does this actually mean in practice? Take VUG as an example. Currently, it trades around $460 per share. After the 6-for-1 split on April 21st, the new price will be around $75 per share. Your total investment value stays exactly the same. If you had $4,000 invested before, you still have $4,000 invested after. The only difference is that you now own 6 times as many shares. Out of all these ETFs, my clear favorite is VUG. Here is exactly why I'm looking at it during this unpredictable market. First, the expense ratio is practically zero. At 0.04%, you are paying almost nothing to have Vanguard manage your growth portfolio. Over a 20-year investing horizon, keeping your fees this low will literally save you tens of thousands of dollars. Second, the holdings are exactly what you want to buy when tech stocks are crashing. The top holdings are some of the strongest companies in the world. You get Apple, Google, Nvidia, Amazon, and Meta. These companies have fortress balance sheets, massive cash flow, and undeniable global dominance. And right now, the market is giving you access to these companies at lower prices because of short-term fear. Third, the historical performance of VUG is incredible. Over the last decade, it has consistently outperformed the broader S&P 500, primarily because it concentrates heavily on the fastest growing sectors of the American economy. Yes, it is more volatile. When the market drops, VUG will usually drop harder than a total market fund. But that volatility is the exact reason why buying the dip right now is so attractive. But let's talk about the stock split itself. Why does it actually matter? Stock splits do not change the fundamental value of the asset, but they do create real, measurable advantages for long-term investors. The first advantage is accessibility. $75 per share is much easier to digest than $460 per share. Small accounts can easily buy whole shares without dealing with the friction of fractional investing. Furthermore, for those who reinvest their dividends, a lower share price makes the compounding process much faster and much more efficient. When you lower the barrier to entry, you allow more retail investors to participate. The second advantage is behavioral bias. Psychologically, it feels much better to buy 10 shares at $70 than one share at $700, even if the math is identical. This psychological bias naturally attracts new capital to the fund. Over the long run, stock splits are almost always a positive catalyst for an ETF. They signal confidence from the management team, and they usually precede a period of strong momentum. So, how should you approach this? If you compare VUG to a total world fund like VT, the difference is clear. VT gives you maximum global diversification. It is safer, but it will give you average returns. VUG gives you a concentrated bet on America's top growth names. It carries more risk, but it offers market-beating potential. In the current environment, we are seeing the early signs of a strong market recovery, combined with a major structural improvement through Vanguard stock split. And this is exactly the kind of moment that can build long-term wealth. The last few weeks terrified a lot of investors. Many people moved to cash and are still waiting for a perfect signal to jump back in. But smart money does not wait. If you're too nervous to buy single stocks, consider using this current market recovery to load up on a high-quality ETF like VUG before the split takes full effect. You get America's best companies at fair prices, ultra-low fees, and the long-term benefits of increased accessibility. Building real wealth does not happen by following the crowd. It happens when you recognize a recovery early and you have the discipline to buy. Now, I want to hear from you. Are you actively buying the dip right now, or are you still holding cash? Let me know in the comments below. If you found this breakdown helpful, please hit the like button. It really helps the channel grow. And if you want to follow my journey as I build a portfolio to $1 million, make sure to subscribe. Thanks for watching, and I will see you in the next one.